Hello and welcome to week 4 of corporate finance. I hope everybody had a good holiday break and a good little vacation. So I'm ready to get back in the groove of things, and hopefully you are too. So once we start this week, things will move pretty quickly. But for this week, just a reminder, read the mini lecture. You're going to have a forum discussion. It's just going to ask you to post a prediction for what you think the Dow Jones Industrial will close at on Friday. So it is important that you post your discussion forum before Thursday at midnight. Continue with the PowerPoint slides, and you'll have a learning team homework. So a little bit lighter on your coming back from the break. But Chapter 10 is a little bit more intensive reading, so make sure to spend a little bit of time in that chapter, read a little bit slower. Chapter 9 goes through operating cash flows and how they're calculated. It's important to distinguish between accounting cash flow versus actual cash flow. Remember that cash is king. So this time of the year when people use gift cards after Christmas, corporations don't actually record those sales until the actual gift card is used. So when do we actually receive the cash flow is an important thing. Walk through the example on page 269. This kind of carries over the next few pages, but it gives a really good example of how someone can predict operating cash flows to give us an idea about a project. And they even give us an example where they calculated the net present value. So it'd be a good idea to practice net present value again and see if you can come up with the same number on that page. If we look at chapter 10, this one, we look at how firms organize the investment decision. And again, remember the investment versus the financing decision, those two things are separate. Investment is how we're going to spend the money. The financing is how we're going to raise that capital, whether it's through stocks, bonds, or borrowing through banks. But we look at projects, project authorizations. Some are required by law. If you have to meet new ADA, American Disability Act standards. They can be for maintenance or cost reduction. They can be if we have to expand existing business, or the exciting one is that you have a new invention or new product that you're going to bring to the market. But as we go through this chapter, a lot of the what if, we talk about sensitivity analysis, scenario analysis, simulation analysis. So even when you do a net present value, you come to some number, CFO or manager is going to want to be realistic about that number and say, what if jet fuel costs do go way up? Well, what if the labor expenses go down? How does that impact the project? So we want to look at a lot of different variables because there is a lot of uncertainty out there. And such things as simulation analysis, scenario analysis are something that's talked about briefly in this chapter, but it might be something you visit a little bit more in a quantitative analysis class. Two of the main things I want to point out in that chapter 10, they talk about accounting break-even versus an economic break-even. The accounting break-even is a little bit more straightforward. It's just how many units do I have to sell in order to cover my fixed cost. But the example on page 294 with the net present value break-even analysis, walk through that one a little bit slower because this includes an annuity factor out of the back of the table that you have to look at. And it includes the true opportunity cost of that investment. So when you include the opportunity cost, you're going to have to sell a little bit more units in order to meet the investor's opportunity cost. All right, so operating leverage, another thing from that chapter. This is the degree to which our fixed costs play a role in our business. The higher the level of fixed cost, the harder it's going to be to break even, but the likelihood is after I break even, the contribution profit or margin is going to be probably a little bit better. You think about a big company like Ford, they have to sell a lot of cars just to break even, but once they can hit that break even point, it can be rather profitable for them. Smaller company, maybe my fixed cost is relatively low, but after I hit that break even, maybe the contribution margin is not as much in each item. And even as I try to expand the business, I might find that my costs go up quite a bit in order to meet that demand. Okay, last thing I want to talk about, chapter 11. This chapter kind of looks at the historical. This year, I think I mentioned the mini lecture, we've had at least a positive year in the stock market, about an 8% return. Historically, stocks have averaged about 11% if you look at some of the S&P and Dow Jones Industrial averages. But the premise of this chapter is kind of distinguished between a risk-free rate, something like a treasury bill or treasury bond, and the return expected in the market. And the difference between these two rates gives us that premium. So it's kind of the premium investor would expect if I take on a riskier type of asset, such as an equity. So we're interested to see about the rate of these returns over a period of time, because it tells us something about the variance of these returns. The bigger the variance, the bigger the risk. If the average is 11%, and when you're up 25%, next year you're down 25%, well, that's a lot of variability. And bottom line, if I take the square root of a variance, that's where we get the standard deviation. They describe that on page 319. So the more we can know about the relative returns and the risk associated with it, the better we can assess the risk of that type of asset. They also talk about a portfolio rate of return in this chapter that's described on page 325. If you're ever looking at your 401k plans, they may give you an overall performance of your overall portfolio, although you might be investing in a lot of different type of investments. And to wrap up the chapter, we have a discussion of unique risk and market risk. The market risk is one that you cannot diversify away. If the economy goes bad, probably the stocks in your portfolio are still going to be impacted. But the unique or specific risk is company specific. And if I get enough stocks in my portfolio that are different types of stocks that can offset the returns, say if one stock doesn't do so well, the other stock will do well, then I can diversify away most of the company-specific risk, but we're always going to be subject to that market risk. Well, that's it for this week, so hope you had a good break and ready to get back into it, but do email me if you have any questions and read through the PowerPoints and the syllabus, but we'll talk to you soon. Have a great week.